In 2025 alone, over 70,000 crores flowed into Flexi Cap funds. That's why we decided to do a deep dive into this category. Because chances are you're already invested in a Flexi Cap fund or you're planning to invest in a new scheme. After all, Flexi Caps sound perfect. They invest minimum 65% in equities and within equities can invest across large, mid and small caps with no fixed allocation limits. The fund manager can decide as per their expertise how to dynamically change allocations to these large, mid and small caps. And that's exactly why this is such a popular category amongst investors. But instead of relying on popularity, social media trends or just the last 1 or 2 years of returns, at PowerUp Money we evaluate these funds using the right metrics. Through our framework, which takes into account not just quantitative metrics but also qualitative metrics like the fund manager's track record and investment strategy. So today, we'll reveal the names of the top 3 Flexi Cap funds for 2026, based on this framework which helps separate real performers from short-term winners. But first, let's quickly understand this framework starting with consistency. To judge a fund's consistency, instead of looking at just 1 or 3 year returns, we use rolling returns, a far more reliable way to evaluate performance across market cycles. Because instead of asking how did the fund perform in one fixed period, rolling returns ask a better question. How did the fund perform across every possible period? Did it beat the benchmark once or did it do it again and again? That's why rolling returns are powerful. They measure performance daily across hundreds of overlapping periods. Here's how it works. If we calculate 5-year rolling returns, we don't look at just one 5-year block. We start with December 21, 2015 to December 21, 2020. Calculate returns. Then shift the window by 1 day and repeat. And keep doing this across the entire data set. Instead of one return number, you now have hundreds of observations. This tells you how often the fund delivered strong returns, how bad the worst periods were, and how consistent it was across different market phases. That's why rolling returns measure consistency and not just luck. The second factor is volatility. To understand how volatile your fund is, we look into 2 factors, standard deviation and downside capture ratio. So, what is standard deviation? It tells you how wild the ups and downs of a fund are. Basically, how much the fund's returns move away from the average. Imagine your daily step count. Stable steps, 9,800, 10,200, 10,100, 9,900. This is low standard deviation, which is predictable. Now let's look at all over the place steps. 2,000, 14,000, 5,000, 18,000. This is high standard deviation, which is unpredictable. Same logic goes with mutual funds. A fund with low standard deviation means smoother returns. A fund with high standard deviation means sharp swings. Up 20% one year, down 10% the next. Returns tell you how much you earned, but the standard deviation tells you how bumpy the journey was. In short, return is the destination, standard deviation is the number of potholes on the road. 2 funds can reach the same return, but the ride can feel very different. The fund with lower standard deviation is simply a smoother and safer journey. Now, let's understand what downside capture ratio is. Basically, it tells us how much your fund falls when the market falls. If the downside capture ratio is 100%, the fund falls exactly as much as the market. If it's above 100%, the fund falls more than the market. If it's below 100%, the fund falls less than the market, which is what you want. So if the market falls 10% and your fund falls 8%, your fund's downside capture ratio is 80%. That means your fund captured only 80% of the market's fall. And generally, long-term performers fall lesser when the market falls. But you might be wondering, why does this even matter? Because this is more important than just looking at returns. Here's the truth most people miss. Losses hurt compounding more than gains help it. If a fund falls less in bad markets, it needs a smaller recovery period to come back. That's why funds with low downside capture ratio often look boring in bull markets but shine over full market cycles. So a fund with 70-80% downside capture is doing a great job of protecting your money during bad times. And in investing, protection is half the return. The third factor we look at is recency. Not to chase short-term performance, but to ensure the fund is still healthy today. Many funds with excellent long-term track records can underperform for as long as 3-4 years and in some cases may never bounce back. This often happens due to changes in fund managers, shift in investment strategy, or poorly timed sector rotations. That's why alongside long-term consistency, we also analyze 2-year recent returns. This helps us understand whether the fund strategy is still working in the current market environment and whether it is showing signs of positive momentum. This approach helps us to measure the fund's current form, which is important but not enough. What makes our framework truly complete is that we go a step further and look at qualitative factors as well, such as change in fund manager, whether there were structural changes in the fund's management, the fund manager's experience and historical performance in managing funds within this category, and thirdly, the investment strategy followed by that particular fund house. Now let's jump to the top 3 Flexi Cap funds. As we go through each, we will be giving a score out of 100 on consistency, volatility and recency. If the score is closer to 100, it means it is ranked well in that parameter and vice versa. And at the third position, we have the WhiteOak Flexi Cap Fund. This one is a fairly new AMC, founded in August 2022 by Prashant Khemka, an ex-Goldman Sachs CIO who has put together a team of seasoned leaders in this fund. Ashish Somaiya is the CEO, who earlier led Motilal Oswal Mutual Fund. Under their leadership, today the Flexi Cap Fund manages over 7,000 crores. Let's look at the fund's investment strategy. You may be surprised to know that the fund invests in over 100 stocks. Around 39% of the portfolio is in mid and small cap stocks, which is the highest exposure to mid and small cap among the top 3 Flexi Cap funds. So the fund can be slightly volatile in nature. But here's how it tries to control that risk. Only 2 stocks have more than 5% exposure. Most of the holdings are below 5% each. On top of that, the fund also maintains a meaningful cash position to better manage volatility. Now let's look at this fund's scores. Consistency. Since this is a relatively new fund, we have limited rolling return data, mainly 1 year. But even within that short period, the performance stands out. The fund has delivered 6% higher returns than its peers and 10.41% higher returns than the Nifty 500. Over the last year, the fund has moved from good zone to great zone. That's why it scores 86 on consistency. Volatility. As we mentioned earlier, this fund has higher exposure to mid and small cap stocks compared to other top Flexi Cap funds. So naturally, it tends to be more volatile. However, it manages to control that volatility through wide diversification across 100 plus stocks and by keeping decent cash positions. Because of this balance, the fund scores 76 on volatility. Recency. As we have already seen, the fund's recent returns have been strong, as it has beaten both the benchmark and the category average. The recent performance score also clearly shows that the fund has done great over the past year, which is why it scores an 80th percentile in our evaluation. Coming to the second ranked fund, we have Parag Parikh Flexi Cap Fund. This fund was launched in May 2013 and is managed by multiple fund managers, including Rajiv Thakkar, one of the most renowned fund managers in the industry. We have covered a detailed episode with Rajiv Thakkar. Do check it out. The link is in the description. This fund manages over 1.3 lakh crores in AUM. Let's look at this fund's investment strategy. The fund house's founder, the late Parag Parikh, and current CIO Rajiv Thakkar come from the Warren Buffett School of Investing. Rajiv Thakkar is highly disciplined about the price he pays while entering a stock. He also prefers proven businesses that consistently generate cash flows and consciously avoids new age or exciting themes simply because they appear promising. In terms of asset allocation, 75% is in equities. The fund is large cap heavy and also has exposure to international stocks. The fund has 25% in cash holdings and has one of the best downside protection scores. Now, let's deep dive into the factors. Consistency. It is one of the longest and cleanest track records in the category. Across multiple market cycles, the fund has shown steady, predictable performance. While it hasn't always topped the charts during bull runs, it has delivered reliable rolling returns and avoided steep drawdowns. That's why on consistency, the fund scores 85 out of 100. Volatility. The fund follows a conservative valuation-driven approach. It keeps a meaningful allocation to large caps and overseas equities and avoids chasing momentum in frothy segments. Because of this, volatility has been lower than most flexi-cap peers, especially during market corrections. That's reflected in a strong volatility score of 86. Recency. However, when we look at recent performance, the picture is slightly weaker. Over the last 2 years, the fund has lagged the category mainly because it stayed cautious while markets rallied. And high cash levels also acted as a drag. Hence, the recency score comes at 77, which pulls down its recent ranking. And the top fund is HDFC Flexi Cap Fund. Launched in 1995, this is one of the oldest funds in its category. It currently manages over 91,000 crores in AUM. Let's look at the fund's investment strategy. Under the new CIO, HDFC Mutual Fund now follows a value plus growth blend rather than the pure value that it followed earlier. The fund made selective allocations to stocks in growth-oriented companies, focusing on rapid revenue growth and market share expansion, sometimes at the expense of short-term profitability. This fund benefits from a strong investment framework and an experienced fund management team. Even though one of its fund managers, Roshi Jain, is leaving, there is no need to worry because even when the former fund manager Prashant Jain left, the fund continued to do well, thanks to the process-driven style of HDFC Mutual Fund and its solid research team. Let's see the scores. Consistency. Over time, the fund has delivered healthy rolling returns supported by disciplined stock selection and portfolio construction. That's why it earns a high consistency score of 96 out of 100. Volatility. The portfolio is large cap heavy. This diversification has helped the fund manage volatility reasonably well. As a result, the volatility score stands at 69, indicating moderate fluctuations. Recency. In terms of recent performance, HDFC Flexi Cap has been great for the last 2 months. It has stayed competitive within the category, and this improvement is captured in a recency score of 79. So now the big question is, which fund should you pick? We understand that investing and mutual fund selection is deeply personal. So it really comes down to your style of investing. For instance, if you're comfortable taking a bit more risk and want higher exposure to mid and small caps, while still keeping a good chunk in large caps, WhiteOak could make sense for you. If you prefer a value style approach, care about downside protection, and also like the idea of international exposure, then Parag Parikh Flexi Cap might be a better fit. And if you're someone who likes stability, a long track record, and a fund tilted towards large caps, then HDFC Flexi Cap Fund is often the go-to option. And by the way, if you're curious about top funds in other categories like large cap, mid cap, or small cap, you can check all the rankings and performance data on the PowerUp Money app. We review funds every month using this research-led, data-backed framework. We are a SEBI-registered RIA, so all our advice is unbiased and only in your best interest. Lastly, don't forget to subscribe to our channel so that we can keep bringing you more interesting finance content.